Wall Street has spent the last few years totally obsessed with financing the biggest artificial intelligence investment boom in modern history. We've all seen the flashy headlines, right? The groundbreaking software, the super smart chatbots, those massive sky high valuations. But right below the surface, something fundamental is actually shifting. You see, the AI revolution is rapidly and somewhat quietly transforming into a massive debt revolution. In this explainer, we're going to unpack an unprecedented surge in borrowing that is quite literally reshaping the financial foundations of the tech world. And more importantly, we're going to look at the mounting, very real anxiety of the people actually lending out all this cash. Okay, let's just kick things off with a number that is, frankly, a little hard to wrap your head around. $220 billion. That is the sheer amount of AI-related debt issued by U.S. technology companies in 2026 so far. And look, these tech giants aren't just borrowing this cash to buy back their own shares or sit on it. They're borrowing it to build the physical foundation of our future. But here's the catch. When you start dealing with hundreds of billions of borrowed dollars, the rules of the entire game change completely. To really grasp why Wall Street is starting to sweat a bit, we just need to compare where we are now to where we just were. Last year, in 2025, AI-related debt issuance was sitting at a relatively tiny $12.5 billion. Fast forward to 2026, and it has absolutely skyrocketed to $220 billion. We are not talking about a modest, standard year-over-year bump here. This is a totally different universe of borrowing. It is a sudden, massive flood of new debt hitting the market all at once. And to understand why these companies suddenly need to borrow at this breakneck speed, we really have to look at what exactly they're buying. Section 1. Below the surface. The physical cost of AI. So here is the absolutely crucial thing to remember. Artificial intelligence isn't just magic software floating around up in the cloud. Modern AI requires an enormous and incredibly expensive physical infrastructure on the ground. Every single time a tech company trains one of these massive AI models, or honestly, every time millions of us interact with a chatbot, it requires a staggering amount of computing power. You can't just write clever code to bypass this physics problem. You actually have to build out the physical reality to support it. So let's talk about what that $220 billion is actually buying in the real world. We're talking about sprawling data centers, highly specialized, super expensive AI chips, massive cloud computing capacity, the power grids to run them, and high-speed networking equipment to connect it all. The scale is so mind-boggling that the combined spending plans of just the major players, think Amazon, Alphabet, Microsoft, and Meta, are expected to top $730 billion in 2026 alone. To put that into perspective for you, that's more than the entire GDP of many mid-sized countries. Even for big tech, with all their famous mountains of cash, an investment cycle of this magnitude completely changes the math. They literally have no choice but to tap into the bond market to fund the whole shebang. Which brings us to Section 2, the bond investors' worry, anxiety over debt. To really understand this rising anxiety, we need to ask, who are these lenders, anyway? Well, we aren't talking about your risk-loving venture capitalists or startup angel investors. The folks providing this $220 billion are strictly institutional. We're talking pension funds, conservative insurance companies, and massive asset managers. They're buying bonds from investment-grade companies because, historically, tech giants have been viewed as incredibly safe bets. These lenders demand stable, predictable sources of income over the long haul, which means, at the end of the day, this massive corporate debt directly ties back to your everyday 401k or your pension plan. You know, there's a profound psychological divide between the two sides of Wall Street. Equity investors, the stock market folks, are kind of the dreamers of finance. They can stomach the wild ups and downs because they're always asking, how big can this get? Can this change the world? But bond investors, they are an entirely different breed. They are the math-driven pessimists of the financial world. Frankly, they don't care if you build a super intelligent, world-changing AI. They just want to know, am I getting my principal back, on time, and with my agreed-upon interest? And right now, their confidence in that certainty is seriously being put to the test. And that brings us to the first flashing red warning sign in the bond markets. 89 basis points. Because as the sheer volume of AI-related debt has surged, these risk-averse investors are starting to demand a premium to lend out their money. Technology bond spreads have widened out to 89 basis points, which sits about 9 basis points above the broader investment-grade market. Now, I know 9 basis points sounds like a microscopic fraction, but in the world of corporate debt, small changes are a huge deal. If you're borrowing $10 billion, a slightly higher interest rate suddenly adds hundreds of millions of dollars to your long-term financing bill. And this dynamic kicks off a really vicious cycle of AI debt. See, Wall Street doesn't just have an infinite appetite for corporate bonds. Institutional investors have strict exposure limits and diversification rules they have to follow. So the more aggressively these tech companies borrow to build out their AI infrastructure, the more they flood the market with brand new bond supply. When supply goes up like that, the investors suddenly have the leverage to demand better terms, which means higher borrowing costs for the tech companies. And those higher costs, they just make the very next round of infrastructure even more expensive to build. The AI industry is basically creating its own massive financial headwinds. Moving on to Section 3, the monetization math. Building is half the job. Ultimately, every single dollar of this $220 billion debt creates a ticking clock. An AI data center is definitely not a build-it-and-forget-it kind of asset. It requires immense, ongoing cash flow just to keep the lights on and break even. Customers have to pay enough for computing power to cover massive, eye-watering electricity bills, the expensive hardware, the staff, the constant maintenance, those rising financing costs we just talked about, and eventually the cost of replacing all that equipment before it gets obsolete. If AI demand continues to explode, great, the math works out beautifully. But if demand grows even slightly slower than expected, that debt still has to be paid, regardless of whether the AI revolution was a home run or a total flop. Let's look at Section 4, Ecosystem Linked, the Broadcom climax. To really see how wild this has gotten, consider this staggering development. Broadcom is reportedly exploring somewhere between $60 billion and $100 billion in debt financing. Just pause and think about the sheer scale of that for a second. A single company is looking at taking on up to $100 billion in debt, specifically to support AI chip development and computing capacity for its clients, like OpenAI and Anthropic. We aren't just talking about companies using their own cash to buy AI chips anymore. Enormous, incredibly complex financing structures are being created essentially out of thin air, just to prop up the computing capacity of the broader AI ecosystem. The really absolutely crucial point here is how deeply interconnected all of this has become. It's like a giant puzzle. Private equity firms, huge banks, conservative bond investors, the tech giants, the data center operators, the chip designers, the cloud providers, they are all financially tangled up together in this massive web of debt. Now, if AI demand just keeps accelerating, this entire network stays incredibly profitable. But if the monetization part of AI takes longer than everyone expects, this exact same network is going to act like a transmission line. It's going to spread financial stress straight from the humming servers of the data centers right back into the bond portfolios of those conservative pension funds and asset managers. And remember, the bond market is absorbing all of this specific AI risk on top of a much broader borrowing frenzy. Total U.S. corporate bond issuance actually reached about $1.68 trillion through mid-August. That is up roughly 27% from the exact same period last year. AI and technology borrowing is driving a massive chunk of that surge. So right now, bond investors aren't just looking at the AI companies and asking if they can handle their own debt. They are staring at this $1.68 trillion mountain and wondering if the entire global financial system can comfortably swallow the sheer flood of new corporate debt without choking. Which brings us nicely to our final part today, Section 5. Who pays the bill? The final question. So what happens if the worst-case scenario actually unfolds and AI returns disappoint? Well, here is exactly how the dominoes would fall. First up, the tech companies. Facing punishingly high borrowing costs and lower than expected cash flow, they'd be forced to drastically slash their capital spending. They'd build fewer data centers and stop buying up GPUs. Second, the bond investors, those risk-averse pension funds and insurance companies we talked about. They'd start facing severe credit losses as the financial health of these tech giants begins to crack. And finally, the broader financial ecosystem takes the hit, absorbing the shockwaves. It is a cascading effect that starts with an underperforming AI model and ends with a direct, painful hit to the everyday worker's retirement portfolio. Look, the AI revolution certainly isn't ending anytime soon, but it has absolutely evolved. It's gone from being just a pure technology story into a very real, very high-stakes credit market story. Wall Street was more than happy to eagerly fund the dream, but now they're demanding a much closer look at the receipt. So I want to leave you with this thought to chew on. AI is very likely the future, yes. But exactly how much debt can the AI future carry before it actually has to start paying for itself? The clock is relentlessly ticking, the bond investors are watching like hawks, and eventually the bill will come due. Thanks so much for joining me for this explainer, and I'll catch you next time.